S&P 500 at a critical location with the NASDAQ closing under a key support level. Tesla's investor day and how it went. Why Nvidia is in free fall. Why Silvergate is down 30%. CRM is up $30 on earnings after hours. The dollar continues to fall. And why this one bullish indicator is starting to get a little bearish. We have a ton to go over. So we're going to start here with Tesla, and I think this is a really important distinction. You can see the post-market at the time of filming this that we're down to 197. And essentially what we're seeing happen here is just sell-off. It was pretty much a non-event. Just talking about the future, how they're getting into different sectors, talking about how they may be getting into heat pumps and other various areas, and why this is a great thing for everybody. Very little exact specificity on how they're going to benefit, and that was felt after Elon was done speaking. The stock immediately tanked. Elon stopped speaking right around that 5 o'clock mark. And then as soon as that happened, that was it. Even right now, as I'm speaking and filming this, you can see this 3-bar pattern right here. Classic reversal and failure, and we're already cracking. So this looks like we're heading lower. I think 192, there's some support. We'll have to see how this plays out tomorrow. But this was anything but a stellar report on the future and how they're going to get there and create even more value. A lot more macro. For those of you that are new, this is an indicator I actually created. You're looking at Tesla right now. I have to take it out of the way to expand the indicator. The blue line is actually the stock trading. This is a 15-minute chart. The yellow is the 5-day. The green is the 3. And now you have the red. If you put in the pre and post data, you can see that we're starting to roll and we are below all those moving averages. That is not where you want to be. So we're going to have to really watch this very carefully. We had a real hard time today with the 203 level, and we're starting to see more and more of this where we're taking out lows, breaking those lows, rallying to those points, and then just very simply unable to close above them. And I think that is due to lack of demand. Now, I appreciate all your comments, and the one comment that I got a lot was to keep following up on ideas during the week, and that's exactly what we're going to do. So I pointed this chart out on Saturday, and the purpose of this chart was to explain the difference between smart money and dumb money. For our purposes, dumb money is referred to as retail. Smart money, I want you to think institutions or funds. Now, we can see up here that, quote, retail, right, is rolling and they are selling. They got a little too excited. Anything over this line we're going to call is too much happy. And so all of a sudden they're selling now, right? At the same time, institutions are buying. This was great until it's not. Now, what's happening over the course of the past couple days is retail is still selling more than they were selling before. And institutions, or quote, smart money, has stayed stagnant or gone flat. Well, flat is not what you do. You either excel or you retreat, right? You either advance or you retreat. You don't just stop. You don't say, oh, I've had enough. If you're having a good thing, you keep going. If you realize you may have made a mistake, you stop. You reevaluate. If the institutions do not pick up the supply that retail is selling right now, the S&P is going to have more issues. S&P hourly, we can see the neckline right here and the break. You could refer to this as a really wonky head and shoulders. No matter how you view it, you have your declining line right here, which we're just going to refer to as our DTL. And we're looking at the S&P on a 16-minute chart, 1 hour time frame. And we can see these gaps. And one of the troubling things that we were aware of and we've been talking about for some time are these gaps. They're not being filled. And then they started to be filled and we started getting island reversals right here like Friday. And I love a good island reversal. Well, that got negated. Okay, so we are negated now after Wednesday's action. Sometimes we will backfill those reversals and then push higher. We did the exact opposite here. And that is not what we want to see. So the question is, what are we seeing? Well, if we look at this and we get super objective, and that's the whole point of doing this, is to analyze. No one knows what's going to happen. People will pound their chest. Everyone will say, oh, this was so obvious. It's only obvious after the fact. If it was completely obvious, everybody would just simply mortgage their house and put it in the stock market if it was so obvious. And obviously people are not doing that. So I'd rather deal with the analyzation and not the prediction. So if we see this level and how we're acting there, cracked it, gap. Now you're sitting right here. Now this level that we really need to pay attention to, and you can see why. Here we are again, right at that 39.50, okay? And again, these lines are very simple to spot out. Look for periods of congestion. Anybody can do this. It just takes a little bit of practice, and you can see the line right in here and right in here as well, going all the way back to the beginning of 2023. Now, I'm going to make this super simple. If you're on a support line and we have retail selling and we have institutions going stagnant or flat with their holdings, how are we going to hold this level? Is all I keep thinking about. I don't see how we're going to hold here. I don't know whether or not we do, but this would make me very cautious. The fact that we're just sitting here, just sitting on the 200-day as we're just going to assume that we're going to form another H failure. It's not where I want to be, guys. It just really is not where I want to be at all. Now, I have all these wicks. We all know how I feel about wicks, that they determine a change in trend. That's how I view the world. I would think that the change in trend that was down, that we're going to reverse and point up. Now, in front of you are the full rules of the DeMark sequential. And I'm not going to bore everybody with it, but the bottom line is that when you get to this 9 area right in here, then that is supposed to mark a trough or an area where we have exhaustion. And you can see this marked by this green arrow. You can see this dotted line, which will act as a support level, basically saying if you break that 39.06, all bets are off. More troubling is this right here, sell countdown canceled. So basically what they're saying is this may be negated and that we need to pay attention for that. Well, you don't want to be like any other pattern. You don't want to be on the back end of any failed pattern that's supposed to break out. In other words, failed H, failed signal, anything like that will increase supply and reduce demand. Now, there were some whistles going off the past couple days that were kind of telling us that, okay, maybe things aren't as great as we thought. And one of those was when Nvidia decided to come out of nowhere and raise capital, which they're still in the process of doing. And quite frankly, the stock's not going to go anywhere until that's priced and people see their allocation. But now that we're into the gap fill, we're sitting right on top of this core level right over here. So really what we did was just fill that gap, didn't we? Right? We came right to it, filled it completely in. So we'll have to see how this goes and see if we fill this one next. That would be rather nasty. 208, I would not rule it out now. I would not rule that out after what we're seeing in today's action. So it seems to me that the goal is to walk us down and then eventually for this to accelerate and pick up. But we really need to watch this very, very closely. Now, if we look at this gap fill and we look at where we're at, I understand, and I even made a comment yesterday about the fact that they are coming out after being at 140 just to raise capital. But why now? And that's really the crux of the issue, right? And maybe they're thinking that we're a little toppy too, or maybe they think we came a little too far. Now, there is a huge difference in a stock between coming in and dropping down to gap fill down to here, to retesting another major support level down here, to stating that we're just going to simply roll out and come all the way back down to the lows. I am not in that camp that is what's going on here. Okay, I don't foresee that happening, but I don't know what's going to happen. But I will tell you this, could you come back down to a level like 190 down here, retest, build, and then go up later? Yeah, you could. I don't see how with Nvidia beating earnings and raising guidance over the long term, you could get multiple compression, because if the dollar goes up and treasuries go up, and we're going to address that in a minute, then yeah, you could have multiple compression, but you're not going to keep coming out and earning more and more money and having the stock drop. Earning revisions are going to have to be what really puts this company down. But for now, from a trading perspective, watch this, because if you make that lower low, you can absolutely get to that back down here and have some kind of gap fill. This was actually something we shorted today and bought puts on. I did fairly well with it. It moved a little faster than I anticipated, quite frankly. So we know what's going on with Nvidia. We know there's a gap fill. We know they're raising capital. Now, if we look at this key level, which is absolutely glaring, or should be glaring to everybody, but let me just pop it in here so that you can see it. You can see the battle that ensued right there. We can see how this became support and we rallied from there. You can even see it over here. Okay? So this line is very important, and this line is 293. You see another battle right here. Now, here we are in the 200, and guess what we've done again? We've closed under it. Now, I'm not crazy about that close, but what's troubling me is the fact that we're just unable to get above the top of that doji. That is very troubling. And instead, what we've done is if we look at this close and we get very specific, and I do get specific, and I see a close of 291.20, And then I come here and I take a look and realize that that close is below the doji. That is not where I want to be. It's not something that makes me feel really good about the NASDAQ right now. It does not mean that we're going to break. It does not mean that we cannot hold. But this is just another data point. And if we don't have institutional sponsorship, if that does not start turning for us, we're going to be watching that daily to see if we get some action in that. So make sure you subscribe to the channel because I'll cover it tomorrow, especially if it's necessary and we can see what's going on there and see if we're seeing institutions step back in. Right? Somebody needs to buy stock in order for the market to go up. That's not a rocket science statement. You don't need to be trading for 20 years to make statements like that. But you get what I'm saying. If we're taking out lows, we have a problem. If we look at the New York Stock Exchange net high low percentage, we talked about this yesterday and how breaking the zero line can lead to some pretty significant selling. We're going to have to watch this because today we saw it again. We saw it start ticking down. So that's not really where we want to be with this starting to roll again. Again, this is New York Stock Exchange net high low percentage, and you can start seeing that we're rolling here. Now, whenever we see patterns, we want to pay attention to those patterns. The number one pattern that we are seeing consistently is if you have good earnings and you have a good conference call, your stock is continuing to go up the next day. If you have a bad call and bad earnings or a bad announcement, they are having follow through. There is very little contra trading right now. They are actually following the route in which they should be going. It's kind of staggering the move that this had today, but here it is and we're staring at it. Not many stocks right now that are technology related are actually breaking out like this is breaking out right now. And you start realizing that you're over a 10-year high today. It's pretty staggering stuff. Looks like we're heading up to this 205, 206 level. We're going to have to see how this plays itself out. But you can see here very clear, just continuing to respect our little trend line right here. And earnings were good. I mean, it's hard to knock that report. It's pretty substantial. But this is consistent. It started with the meta move and the buyback, and it's just been following through ever since. Good news, stocks continue to rally. It's been one of the bellwethers. Now, tonight we have CRM. CRM came out with earnings, beat expectations, beat on the revenue side, and said, oh, by the way, we're going to buy $20 billion of our own stock. Sitting right there on that 200, and they make that kind of announcement, and now you're flipping that higher high, and you're coming right into a major resistance area. I think this is pretty significant. And it wouldn't surprise me to see something like this continue to push, despite what the market does tomorrow, the same exact way we watched First Solar not give a hoot. And that's a nice way of saying it because that's what we're saying. Now, to just touch base on some of the other things that are concerning to me, and I'm trying to mix in the macro with the stocks. If you think that's a good idea, just let me know. Or if you'd rather have all the stocks done at once and then all the macro done at once. I'm not really sure how I feel about that, but I think I like doing it in the order that I'm thinking about it because I don't script these. So just comment below if you'd prefer just to see it mixed or matched, or frankly, even comment below if you just don't care. That lets me know that I'm probably paying attention to something I shouldn't be. So what we're seeing right here is we're just seeing weakness in the high yield market. This is not where we want to be once again. We do not want weakness in the high yield market. We do not want HYG breaking down and breaking trend lines and unable to rally. That's not exciting. It does not make me feel warm and fuzzy, nor should it make you feel good. So we rallied up to our trend line. We've completely rejected that trend line. And then what? What happens after we rejected right there? Then now we're gapping down and now we're going right here, right? So now we have some issues. I don't like the fact that that's happening on high yield. And it's even more troubling than that. You take into account that TNX really is not lighting the world on fire, right? Like it's not really up that much, right? So you had an okay day, but you didn't have like this great day. You moved about 2 basis points off or a basis point off of where you were the day before from a high to a high, right? It's not like you're lighting the world on fire. And on top of that, this is what's really troubling. Yield on the treasury is not moving, but I have the dollar selling off. So the dollar selling off and equities are still dropping. That's not what I wanted to see at all. Okay, so now we have this rising wedge and we have the dollar starting to break. And maybe this is the thing that saves the equity markets and causes that bounce we're talking about and spurs institutions to start upticking again, i.e. smart money, how we just went through that. Hopefully you can start seeing how all this is connected and why it's important to pay attention to all these nuances. So now you can see how we're fighting this level right in here, right? So we crack and the NASDAQ still drops and no one still doesn't want high yield. That's a concern. Okay, that's a concern. Something's off. And if you're trying to figure out what's off, there's one way that you can look at it, and I'll go through that in a minute at the end here to wrap it up. But I just want to go through snow. Snow was not bad. I did not think it was a bad quarter. The issue with snow is the price to sales multiple is through the roof. It's not even worth mentioning. The fact that we are now getting below that 200-day, the fact that we are breaking this trend line, and we're consistently breaking that trend line, you just need to stay out of the way, okay? You just really, it's actually even cleaner than that. I'm going to draw it pretty clean. So you could see the close right here, and you've never been over it. And now you're just fighting with that 200. And quite frankly, the fight with that 200 is now over. And you're going to have to watch this level tomorrow, 145. That's what I was hoping you were going to hold tonight. And guess what? You did not hold 145. So we're going to have to watch that. We had a real battle going on in this one, and I think it's really important to bring this up. And it fits right into when we talk about smart money versus dumb money. There's a reason why I would prefer to call it institutions and retail. SI today came out and made a statement. Their statement was pretty clear. That 10K we're supposed to file in March, we're not going to be able to follow that, and we might not be able to stay in business, essentially is what they're saying. The damage might be too great. And of course, they're blaming somebody else. Shocker. The problem that I have here is that retail investors were right on this and calling that this thing was going to blow up. They were actually, a couple guys were actually dead on this, and they were 100% right. And we were sitting there watching BlackRock take a huge stake, Citadel take a huge stake. We watched a guy here that was in the space, 16% stake. Okay. Now they don't know if they're going to be able to stay in business. This is a real issue, and you should be paying attention to this if you like to short stocks. And people say, well, it's $9 now. Well, WorldCom was $9 and it went to zero. Enron was $9 and it went to zero. If you have patience and you can set up your parameters around it, there is still money to be made shorting these, and you can just marry calls to it. I should probably do a video on that, on how to marry calls to short positions. I do it all the time. It does reduce your profit, but it mitigates your risk. Comment if you want to see that, if you think that's a good idea. Now, just to review, the fact that we're sitting here does not mean that we're going to break. The fact that we have some patterns that are negating does not mean that either. What is troubling is that if retail continues to sell and institutions do not step up, if the dollar continues to fall and nobody cares, if high yield is not bought, it's very difficult to see how this market goes up. I don't know that we're just going to stay stagnant. We very well could stay stagnant in here for a period of time and then build up in the S&P and the NASDAQ. That could happen. I would think with retail pressure and institutions not stepping up to the plate, should that persist, I would imagine that we see weakness. So I hope this was helpful. Make sure that you get the newsletter. It's free. There's a link in description. It's going to start coming out and be more active. The reason for that is because there's a lot going on right now and I want to cover it. Everybody have a great evening. Trade to win tomorrow.